A DSCR loan is a mortgage for an investment property where the lender qualifies the property, not you. That's it. That's the whole thing. DSCR stands for Debt Service Coverage Ratio. It's one number. It compares the rent the property brings in against the payment on that property. If the rent covers the payment, the deal works. If it doesn't, the deal probably doesn't. No tax returns, no W-2s, no debt to income calculation on you personally. That's what a DSCR loan is. Now let me show you how it actually works, because the number is where people get tripped up. I'm John Taw. I'm a mortgage broker with Edge Home Finance. My team helps families and investors in 49 states, and we pre-underwrite every file ourselves before it even goes to a lender. I had this conversation on the phone probably like 200 times. Same question every time. So let's just run the numbers together. I've explained DSCR so many times, my dog knows the formula. She still won't qualify, no income.
Hey, John. I've got great credit, no income, but I got a great personality.
It's not one of the three. The formula is one line. Rent divided by the payment. That's your DSCR. But the payment isn't just the principal and interest. It's the p.i.t.i.a. It's the p.i.t.i.a. Principal, interest, taxes, insurance, and association dues, if there are any. So let's do a real one together. Say the property is a single family rental. Rent is $2,200 a month. Now, the payment side. Principal and interest comes out to $1,400. Taxes are $320 a month. Insurance is $110. No HOA. $1,400 plus $320 plus $110. $1,830. $2,200 divided by $1,830 is 1.20. That property brings in 20% more than the cost to carry. That's a real number. That's the whole qualification. Notice what I didn't ask for? I didn't ask you what you make. I didn't ask about your tax returns. I asked you what the house makes. So how is it different from a regular investment property loan? Great question. Documents. That's the difference. On a conventional file, the lender is underwriting your personal income, 2 years of returns, pay stubs, and every mortgage you already carry lands in your debt to income ratio. That's why investors hit a wall around the fourth or fifth property. Not because they ran out of money, because they ran out of ratio. Conventional says, prove you can afford it out of your own pocket. DSCR says, prove the house can afford itself. That's the entire difference. Everything else is paperwork. Let me be honest with you about who this is actually going to be for, because a lot of people are watching this and they're going to click it off in about 40 seconds, and that's fine. Who it's for: self-employed borrowers whose tax returns show write-offs that make their income look small on paper. Investors who already own 3, 4, 5 properties and keep getting told no on the next one. People buying inside of the LLC. W-2 buyers who just don't want to hand over 2 years of financial history for a rental. Who it's not for: primary residences. You cannot buy the home you live in with a DSCR loan. It's an investment product. If you live there, it's the wrong tool, full stop. Second, homes you're not renting. Same reason, no rent, no ratio. And the deal is where the numbers just don't work. If the rent doesn't cover the payment, a DSCR lender isn't going to talk themselves into it. Neither should you. Here's the big one. People call this a no-doc loan. It is not a no-doc loan. It's a different doc loan. You're still giving the lender documents. You're just giving them property documents instead of personal income documents. Second misconception. People think DSCR means no credit check. It doesn't. Your credit score still matters, and it matters a lot for pricing. Third, people think it's a hard money loan. It's not. Hard money is short term, usually 12 to 24 months, built for flips. DSCR is typically a 30-year loan on a rental you plan to keep. Fourth, this is the one I care about the most. Most people who get told no on a DSCR file didn't get told no because they were the wrong borrower. They got told no because the file was structured wrong. Wrong lender for that property type. Rent documented the wrong way. Entity set up after the fact instead of before. That's a structure problem, not a borrower problem. Structure first, then you buy. Okay, back to the numbers, because this is what determines whether you get approved and what it costs. Most lenders want to see 1.0 or better. 1.0 means the rent actually covers the payment, break even. 1.25 means that the rent covers the payment with 25% cushion on top. That's a comfortable file. Generally speaking, the stronger the ratio, the better the terms a lender can offer you. Now, below 1.0, say you come in at 0.9. The rent covers 90% of the payment and you're covering the rest out of your own pocket every month. Some lenders look at it as sub 1.0 files. Some won't touch them. When they do, expect a larger down payment, tighter terms, and more scrutiny. And it depends entirely on the property, your credit, your reserves, and which lender we take it to. I'm not going to tell you a specific rate because rates move and your situation is yours. What I'll tell you is this: the ratio is the lever. Improve the ratio, improve the file. So here's where you actually are right now. If you just learned what DSCR means today, you're not behind. Most people who own rentals didn't know this either until somebody sat down and ran the numbers with them. You don't have to have a deal picked out. You don't have to be ready to buy. You can just want to understand the number. This video is part of a series. If you want to see this run on a real scaling scenario, watch the portfolio video in the playlist. If you're looking at short-term rentals, watch the other video about DSCR loans for Airbnb and short-term rentals next. The rent side of the math works differently on those, and it's worth understanding before you write an offer. If you want me to run your actual numbers, my info is in the description. No pressure, just clarity. 10, 20 minutes, and you'll know where you stand.